And we're back to the Crash Labs. It's been a long hiatus, but with me today, a very, very special guest, Mr. Otavio Costa, otherwise known as Tavi Costa. Tavi, I've known Tavi, great benefit. I've known Tavi for a long time, and a big fan of his work in the space. Tavi is a macro strategist with Crescat, which is a hedge fund, and they're pretty domain focused on the mining space. In fact, almost entirely. Tavi, if it's okay to characterize it as that. But anyway, Tavi's phenomenal. A lot of his charts go viral across the natural resource investor world, and for good reason, because they're great. So anyway, without further ado, Tavi, welcome.
Thanks for having me. Not as far as your podcast, but I'm glad to be here. It's great to connect with you again and finally doing an interview. So that's awesome. So looking forward to this.
Yeah. Likewise. And so Tavi, I mean, I just want to get right into it because I know you've covered your background with other interviews, and usually I do that. I don't mind doing that. I would love our listeners to learn a little bit more about Tavi, but with everything going on in the space, I think a lot of our listeners are going to know exactly who you are. What's happening in the last few days? This is being recorded on Thursday, the 23rd, I believe. Are we the 23rd today? Is it?
Yeah.
Yeah, Thursday the 23rd. Shit kind of hit the fan here on Friday. There's a sell-off. It seems like a lot of people are panicking, but what the hell? Like, then now everything's kind of picking back up again. So what was that? And where are we?
Look, we do a lot of, sometimes macro trades in the funds, and just want to make sure that everybody knows I'm not trading on these things I'm going to say. But what we've seen so far was certainly one of the biggest increases in gold prices probably in many decades. And I suspect it's being pushed by the U.S. government, if I would say that. I mean, I certainly think that there's a need for the U.S. to finally start increasing its gold reserves, which has been what has been reported, and who knows if they actually have what they report, at a 90-year low, while the rest of the world has been in a 50-year highs of global reserves. And we also don't know if they report everything they're purchasing. And so when you think about, from a logical standpoint, if you're Scott Bessent coming into this as a Treasury Secretary trying to deal with the situation, and you're being asked the question, are you going to revalue gold and do all these things? Why would you revalue gold if you can just buy it in the market, accumulate even further, and drive the prices higher and help the Treasury, because the Treasury has a large reserve supposedly that could help them on their finances, now north of about $1 trillion. And I think it's exactly what's going on. I think we will know about this in a few years. Don't think anybody knows the answer for that. And the reason for it has to be a central bank, is because this type of movement, we tend to see these things in manias, but even manias have their pauses. This has been a pretty large increase that clearly was not driven by institutional capital, because institutional capital is very focused on some level of technical indicators of overbought, oversold, and when things go up too much, institutional appetite tends to change a little bit. Central banks don't work that way. That we know that for a fact. All they're seeing is that they have a very low amount of percentage of their balance sheet in gold relative to what they usually have. And so, this has been a nonstop purchase of gold. And I don't think it's just the U.S. It's been driven, diversify across the globe. And it is, I don't want to get in front of it. Like, I think it's being too cute trying to time this whole thing and understand, all right, well, we're going to see normal markets, a decline like we saw on Friday, another decline 2 days ago, and then followed by yesterday's reversal. You should see some, volatility should increase. That should create some damage psychologically, and you should see some digestion at these level. Am I going to bet
a resumption of just back to the same?
That would be the normal. But would I bet on that? No, it's not my business if this thing keeps going up. I mean, we own a bunch of miners. We'd be happy with that. But the normal of an asset class, if this was any other asset class, not necessarily driven by central bank purchases, you should expect some level of digestion here. But
so you don't think this is a sort of, I guess in some tangential way, this is what you're saying, like with the central banks reacting and with sort of a broader purpose, like Bissett coming in and saying, okay, we've got a problem, and this is maybe how we can at least offset the problem, load on gold, rock the price, and just go hog wild accumulate. But do you not think that this might be the masses starting to say, okay, this debt thing's a problem, inflation is a problem, wars, conflicts, all this? Like, is any of this a retail fear thing right now where they're going, okay, like, which is sort of what a lot of people have been betting on gold for, at least the cyclical kind of bulls would, hard asset people would argue?
Look, anecdotally, I mean, I'm sure you have family members and friends that you shared about gold and went on the rabbit hole of having a drink over what gold means and so forth,
right,
and caused some of your friends or family members to buy gold at some point. And I've been getting calls from my family members. Funny enough, it's not calls, should I buy more? The calls were all evolving around, how much should I sell?
Right, yeah, right. Yeah, I was getting that too, yeah.
I find that fascinating, it's just because I think the question, we all worked under assumptions here. None of us know the answers. I think what I have conviction to say, this is not a peak, type of cycle situation where, the level of decline that we saw on a daily basis of gold prices and silver or the miners is certainly the type of behavior you tend to see at a peak level. But I, with high conviction, would say that we don't usually hit a peak of the cycle with gold to silver ratio at 85. And that's just not usual. So volatility will be here for a while, most likely. We may see some digestion at these levels, but I don't think this is, I don't think we're going back to 2,500 gold price environment at all. Like this is our 3,000, back to, low 3,000 environment. I think this is, the train has left the station now. And I've got, I think it's interesting how the government's getting engaged with this as well, because outside of what I said before, I think that there is some, interesting things happening with engagement of the U.S. government starting to acquire assets, equity controls in companies, the NP material deal and so forth. Those are things you usually see in World War II scenarios. They're not bailouts. It's very interesting. And for that to start going into the gold space is very quickly. I mean, all of us, what we learned in our careers and why we're in the mining industry is that we barely buy gold physically. I mean, what we do is we think gold is much cheaper in the ground. That's why you wake up every day to run your businesses and invest in the things you invest, and the same here. And the government is figuring the same thing out. And at some point, they're going to get involved on either streams or royalties, or I don't know what's going to look like, but that's coming. And yeah.
Yeah, like it's an interesting take. I think one of the things I've been watching too, obviously, I remember hearing Pierre Lassonde talk about this a long time ago, which resonated with me, just kind of laying it out super simply, which is the transition into hard assets. Like the big, the sort of ebb and flow of the macro, market, and you had this sort of like soft tech ideas market. And eventually that, just like the .com bubble or whatever, we've had these periods before, and then all of a sudden you transition into like more of a hard asset market, right?
Yeah.
And so I sort of like think that way, and then looking at like things like NVIDIA, right? Like, so we had all these like tech giants, and a lot of them were like ideas companies, and then suddenly now like the king of that castle is like NVIDIA, which makes hardware, all these sorts of things. So it's like this sort of transition into sort of like a more real, tangible, fungible world. I also heard that like Tether was spending billions of dollars, I believe, a week buying gold. And so I don't know how like to me it just sort of seems like yeah, okay, so if that's true with the central government, like a central bank loading up and manifesting what we're seeing, what about all these other things, all these other big movements? Like it just seems like a big, more of a major movement. Now I noticed, interestingly enough, you mentioned something about oil in another podcast I had listened to you on. And that's something I've been harping about too, which is like how oil is still so cheap and an interesting hedge in some ways to this, but also an interesting optionality play right now for a lot of people who are like, well, mining has done me well so far, but I'm having a real hard time unplugging from mining. Like I don't want to sell anything. I believe this has just begun.
Yeah. I think the biggest risk we both have being heavily invested and concentrated in mining and being in this industry for some time now and seeing the ups and downs of valuations and being in a very severe bear market that we've been through over the years here. And obviously not now, but in just a few years back, things were very bad in the market space, and the lack of capital and total neglection of this industry overall. But I think our biggest, that's the way I'm operating in this cycle is being extremely open-minded, because I think the biggest issue we're going to have is we're going to reach some stupid valuations, like real mania things. Like we usually say, whoa, exploration company shouldn't reach $1 billion. Well, if it's high quality asset and we're in a crazy bull market in gold space, be open-minded. We could see a lot more than that,
I agree.
And if that's the case, you want to own the best high quality stuff you can find, the best teams that are out there to operate. And we don't know what the peak of the cycle will look like. We're certainly probably not in the peak of the cycle. That's my view. But if that's the case, think about it. What would that whole assumption of $1 billion valuation of an exploration company tends to reach? Usually, that's sort of the conventional thought in the market. What would that look like in a high quality asset that is in process of finding maybe 10, 15 million ounces of gold, and gold prices are at $7,000 an ounce? I have no idea what that could be priced at. So
yeah, no, it's a fair point. I mean, look, like even in the tech world, when we launched Gold Spot Discoveries, say like many years ago, like I don't even remember what year it was, maybe 2019, I think we went public, but we were a private probably earlier than that. I would say 2016 is when the whole thing started, 2017. And, so going on 10 years ago. So we launched that. What was so we were like the only AI company for mining, right? And but at the time, it was sort of the advent of AI, right? You had all these like publicly traded, and I remember some metrics that were being thrown around, like, you get $30 million per PhD with a data science PhD. Like that was the measuring stick for an AI company. It had nothing to do with revenue. It had nothing to do with revenue multiples, recurring revenue. None of these features mattered. It was like who is your team, and you're going to get your value is attributed to how many PhDs you have. Mm-hmm. And we went public at $38 million valuation with 7.5 in the bank, and we had revenue. In fact, at the time, there was a company called Element AI, and Element AI was this big kind of consortium, sort of blue chip, IPO, Toronto tech, Montreal tech, AI thing. And I think it had $500 million or $1 billion valuation. We had more revenue. We had more revenue and actual tangible people, like actual data scientists doing real things than Element AI did. And I remember showing it to the analysts, and they're like, well, like, why are you guys? It's because we were pandering to sort of a mining crowd. But I mean, you're right in the sense that, like, in a bull market, that was, I guess, the comparative there is that the tech was very much in a bull market, and, that was an ideas company. And we were, somehow lumped into this sort of mining sphere. But in the end, I do recall the last bull market. I recall working there. I remember the valuations. I remember working for a company. I won't even name it. I think I may have named it before, but just for the sake of just not kind of throwing mud there. But I remember working for a company that was building their first mine, and in Timmins, and it had a $4 billion valuation. Its ounces got cut basically in half on a recalc of their resources. It was struggling. And it wasn't anything crazy. It was like a few million ounces at kind of like break-even grades type situation. But it had I think it was a $4 billion valuation then. And that was the single asset, that was what was going on. And so, I mean, we're a long way off of that. I mean, we haven't seen that yet. $4 billion.
Yeah,
right?
If the gold market now is about $30 trillion, what's the mining industry supposed to be, in this environment? That's just gold. Copper is another 7, 10, silver is about 2 to 3. So we're talking about 40 something trillion. How much percent of that should be the mining industry? I mean, I can pick a number here, but it shouldn't be 2%. So, right. And so this industry has a lot to, and I personally think there's a reason behind why we haven't seen institutional capital over the years in this industry. And I think some of it has to do with the complexity of it, certainly. And the complexity is, I mean, it's very difficult to get your arms around, especially development and exploration phase of this industry. Producing side is relatively easy, but even that, like when we looked at companies privately to acquire, like we did with St. Cristobal, we've been doing this, trying to do this when it makes sense. And we looked at the models. Everything is predicated on your assumptions of gold prices or silver, whatever you're looking at. And the assumptions or the consensus long-term prices for gold, for instance, in a mine today, any mine you try to buy that is for sale now, that any bank is running the process, what you're going to find is that the prices are usually 20 to 30% lower than the spot long-term. So your long-term price is usually, like not too long ago, literally a month ago,
they're using like 3,000.
2,500
or 2,500 or something.
I couldn't believe it. I was like, so you're assuming we're going to go down 30-40% on the gold price? Like, where do I sign? That's an arbitrage. As long as there's no issue with the mine. It's.
Well, what's so crazy about that is if you were to roll back the clock to 2005, right? So I remember like 2005, 2004, like that pocket, 2003. That was right when I was kind of getting in. And there was like, gold was around $300 an ounce. And I remember people getting squeamish at like 500. I remember touching like 580 or something, and it was like, like everybody sell their shit because gold's going to. And the same thing, people were doing PEAs, and they were using like the $5 price, and it was like a big boo-boo. And years later, we're talking about $2,000 gold. And now it's in a bear market, it's consolidated at 2,000. So like in that 2,000 to 3,000 range, this is like, well, what's the ceiling on this run? That's the way I'm not a macro guy like you, but that's, I'm a dummy, but that's where I'm at.
Oh, I'm a dummy too. I just happen to just love to spend a lot of time looking at these things and end up I love doing what I do for a living. But I think it would be interesting when banks start really building a contango curve for macro assumptions on gold.
What's a contango curve?
Okay, so just, future prices would rise, not fall.
Okay.
That would be the normal. So let's just say we assume 10% compound annual growth for gold prices all the way back to the 70s. And we say, well, that's a pretty, normal rate of return that you should expect on an annual basis. Of course, there's going to be years down, years higher. Then you say, well, 10% might be too high. Maybe we should cut in half, say 5%. Okay. If you take any mine privately for sale now, okay, or maybe it's a public company selling a mine, and you look at the model, and you apply that 5% increase every year, we're going to see a compound growth of 5% in the gold price. These things are just a steal, like,
Right.
nothing, or even Newmont or Barrick, any of these mines. If you go down and say, all right, well, why are these guys putting a price target for this in Newmont? And you start diving into that. I did that myself in a few of them just for curiosity, and started to go deeper. It's like, all right, well, why are you assuming that for that particular asset that Newmont has or whatever? And it really goes down to, okay, lots of assumptions, but the main thing that really matters is your gold assumption that would change your NPV really in a huge way. And all these assumptions are 30% lower long-term prices. And, the institutional capital is not doing that type of due diligence when they're investing in these things. And so I find it fascinating that once we start applying that or bridging that gap between the institutional money and us that have been in the industry for a while, explaining those things, what type of valuation we're going to see here? We could get in a crazy world here, especially when you start talking about crazy numbers for gold. What we talk about, the compounding growth of gold prices from the 70s. Wait a second, is that too conservative? Because the 70s, we didn't have the amount of debt we have today. Deficits were not 7% a year. We didn't have current account deficit of another 3 to 4%. We're not running a double-digit deficit on the current and the fiscal account. We're not over 100% of debt to GDP. You start running these numbers, you're like, oh my gosh, like that's, we're actually being too conservative here.
Well, yeah. I mean, Matt, my colleagues, both Matt and CJ, on a couple of podcasts ago, they were talking about, I'm going to butcher the numbers, but I'll just make them up. So don't anybody actually quote me on these. But basically, they were saying the entire venture index was, say, worth, I don't know, again, make up the numbers, 30 billion, right, or whatever. And that was the peak of the last cycle. Right, so the peak of the last metal cycle, and the venture is largely comprised of mining goodies, right? And so they're saying like at the peak of the last one, it's like a 30, and right now we're only at 7. So like, I mean, if that's of any indicator of where we're at on the sliding scale of is everything priced in yet? But even as an explorer, Tavi, like, I like to do big things. I like to get big projects, and I like to spend big money. Like that's when I explore, I don't like having one drill pecking away for a couple of weeks and then I'll see you in 6 months and do it again. Like that's not my game. If it's go time, it's go time. And I think in the bull market, that's the way people explored. It was go time. And right now I look around and I go, yeah, there's been money raised. There's been a lot of those life deals with the warrant, and single digit millions being raised to explore these things. And there's sure, so people are saying, well, there's money being raised all over the place, but is there? Because none of those things are going to be serious. My thing's serious. The things I'm in, I like. Not all of them are there yet, right? But a lot of what I like to get after has serious capability to turn up the volume. And until I see a market that's saturated with those types of companies, I don't think that we're there yet.
Yeah, you guys have a rare, good track record of doing this in the exploration phase. And it's a part of the industry that, for some reason, even with the market moving as much as it has been moving, it still is not getting enough love. You start going, majority of the billionaires in this industry, pretty much all of them made their money on the exploration side. And then it's funny how they now talk about the development side has been where they play. But all of their money, 90-80% of their money was made on
juniors.
On juniors. And so, I find that interesting as well. But I don't know how to bring institutional capital into this. I mean, institutional capital at some point went to tech and all these ideas that are just, completely crazy. What I think it's going to happen, though, is that the gold bug mentality and the gold industry mentality, I should say, is very disciplinary in terms of, of the fiscal situation and all that. I know we bleed capital as mining companies for a long time, and that aspect is not disciplinary. But what I'm referring to is the investors that are part of it, not the miners. The investors that are part of it really think about discipline, value investing, and all these things. I really think that their biggest issue that they're going to be coming across in this cycle is going to be their own minds, telling themselves to sell those assets too early. And it wouldn't surprise me if the people that don't know nothing about mining would actually end up making most of the money in this whole cycle.
Oh, right. Yeah. It's just like selling prematurely, but at least, hey, no one ever went broke selling early.
That's true too.
Like
that's
selling
true
on a
too.
profit, right? So there's a lot of people. I mean, one of the interesting things I remember, so back to this whole oil thing, and I know we didn't really touch on it, but
Yeah.
just as a sort of, it has crept up again in my mind. One of the things that was scary about oil in the last cycle was that oil was too political, right? Mm-hmm. If you really tried to play oil ended up playing you, because all of a sudden it was like this government's doing this and this politician said that, and all of a sudden like the price per barrel started getting crazy. Then production, it's very, very political. And I'm actually wondering this time around, with all of the circumstances of the world in this bull market that we're venturing into with gold, is gold going to be very political this time? Is there going to be like an injected volatility to gold that, because that was like sort of the scary thing with oil at the tail end of the last one.
Yeah, I don't know the answer to that. To me, it's just fascinating how people tend to miss the extremes on things, especially in macro, because they try to justify these extreme moments in history with unreasonable answers. For instance, the gold to oil ratio, right? Right now, we're second largest level in history. And you tell that to anybody, and people don't care about. They think that oil is cheap for a reason and so forth and blah, blah, blah. When positioning is one of the most bearish positionings we've seen in history. You look at the number of drills from basins like the Permian started to contract like over 30% in the last 2 years. Now, these are not efficiency changes. These are, clearly companies that are not drilling as much as they used to, and that's going to have an impact on production. There's so many verdicts you can go through. And even looking at the U.S. inventory today, just look at the U.S. oil inventory, one of the lowest levels in history. Yesterday or 2 days ago, the Department of Energy declared that they're going to be buying, they're going to be replenishing their SPR, the Strategic Petroleum Reserve in the U.S. Small amount, but that gives you a sense that there's a floor there. So if you're a company operating under that assumption here as well, I think that's a wonderful environment to be in. And you can think in two ways. You can think as a miner, or you can think as an investor. As a miner, if you're Newmont or any consistent producing company of metals, and you're not hedging your energy costs right now, it's almost criminal in my view.
Right.
I don't even know what's the other side of the argument, really. It is prudent to be doing that right now. And I say this because I love this industry, and I want this industry to do well, and I want them to protect their margins. That's the most important thing you have, right? Everyone is making money in the mining. If you're not, I'm not sure what you're doing, but everyone in the mining industry that put any penny in it is probably making money. And if you're thinking about as a miner, your thought should be on your margins. How do I keep that? You have zero control over gold prices or silver or copper, but you do have control over your costs in some sense. And one of them is energy. If you're an open pit project and 30% of your cost is energy, you should be thinking about that. We at St. Cristobal, actually, we did 3 years out, energy cost is hedged. Yeah, did cost us a little bit of free cash flow. Gosh, we're all making money in this industry. It's not unique to you. It's unique to this whole
everybody's
industry.
doing it. I made money on Sedge Cristobal.
And so there you go. And so the other way to think about it though is as an investor, you have a heavily concentrated portfolio, and you made some money. I'm not saying sell your mining stocks to do this. Maybe you receive some more capital for whatever reason, and you got new money to be deployed. Consider allocating some money into energy. I mean, this is another way to think about your margin as well. What's your risk? I think a lot of people tend to think about their risks being another '08 environment, and an '08 environment tends to occur when you're not in a place where you can truly expand your monetary base as much as you are. We're not in that world right now. I mean, if anything happens like that, we have a 20% crash in the market. I think Trump comes in with a bazooka, or the Fed, or who cares? Right. And your biggest issue here is oil goes to $200 to $300 a barrel because of a war, because of an inflationary run, or whatever that happens, and now your mining companies that you own are starting to get hurt on their margins, and that starts to change assumptions as well on your or considerations of free cash flow in the future. That changes your present value. Oh my gosh, now everything changes. You get a correction in your mining, and you actually see oil companies do well. So I think it's very prudent and a smart capital allocation to consider owning some energy in this environment. I
agree with you. I think it's a great hedge. I think it's a great. There's a sort of duplicity there, but I'm just curious. Like right now, it's an obvious bet. My question is, if oil goes to $200, I probably would set that out. I'm probably up there. I'm probably going to go, okay, this is too political for me, as always. Out of here.
I would agree.
Right.
Yeah.
But
I'm out.
Yeah.
At $59, $60 a barrel.
Yeah.
Where do I sign?
Baby. Yeah, exactly. Back up the truck right now, actually.
The same thing goes to emerging markets. Is the same idea, right? In emerging markets, when the gold market kind of starts flowing and you start seeing capitals, the gold, it's all an acceptance of risk exercise, and people understand the gold market. It's got centuries of history. I'll put 2%, 5%, 10% of my portfolio, maybe more, into this. And I'm talking about institutional capital that doesn't know anything about gold, and they start really feeling comfortable with that, and they make money. The next step is what is the next thing I'm going to make money on? Then you start feeling comfortable with silver, copper, larger mining companies, and you start making money on the small miners. And you understand now that there's something really interesting that happens with emerging markets. They have a really strong correlation. Usually, most emerging markets, there are some exceptions in this, but they have very strong correlation with resource prices, and so commodities per se. And commodity prices rise, economic activity rises, and you tend to see growth. There's nothing better for an investor than finding a low PE multiple that is about to explode in growth. And when you marry both, that's when you see exponential growth in prices. So I think emerging markets are kind of in that environment, and we all saw the wave of gold. We're seeing the wave of the miners. We're seeing the wave of the juniors. But nobody's looking beyond that and saying emerging markets is the next thing to come as well. And so that's another place to be looking at for smart capital allocators. I think should be considering to look into emerging markets as well. And to your point about oil, the analog for the same idea that you had, when we hit 200 in oil, probably should be a seller. The way you should think about emerging markets is when you start hearing that emerging markets are going to develop to become actually a developed economy, that's the time you want to sell it.
They're not quite there yet.
So it never happens. Brazil has been an emerging market since I was born, and will be the case until I die probably. So there you go.
Crazy. So this is sort of back to you and your charts and what you do. How do you come up with this stuff, man? Do you play with data all day, or do you stumble across this stuff? You go, I could just do that better. You have ideas. Like how does this all string together for you? Because these things are really amazing. Like you do share shit that everyone shares, and I literally can't say that about many people.
Thank you very much. I'm sure quality of your work on exploration and all that. I think most of the high quality work you see in any industry or any part of the industry as well, I think it comes from independent views, really diving into what you believe, rather than reading. I spend 5% of my time reading people's analysis on things. Turns out that to have your own conviction and have your own opinions, you have to do your own work. It's just, it sounds obvious, but a lot of people, what they do is they don't do their own work. They just follow other people's work. And that's the majority of the investment community. And I've always been of the view that you want to be a thought leader and not, like there's a few thought leaders in this industry, and they pose a view or an analysis, and then everyone follows, right? And like I'll give an example, like this chart that I posted on was about central banks. I'll share the chart here since you said I could share.
Share, please. We'll put it up for the benefit of everybody. Yeah.
This chart right here, done. There you go. It's got around, right? It was a chart about foreign central banks, how much they own of treasuries versus gold.
Yeah.
That sets a narrative, right? Like now for a few days, people were talking about not this chart, but talking about this topic, right? And it was a topic but that's one example. There's examples that happen every day on X. Somebody's going to share something that becomes a narrative. It could be a short seller talking about something, or it should be maybe a analysis on banks or something that happened in China, and that becomes a whole topic. And most of the commentators are usually chasing, or investors chasing, the political narrative, right? The geopolitical narrative. So usually like something happens in Iran and all these guys become experts in Iran now, right? Like all these people that know nothing about Iran and now commenting like they know something about it. And I avoid this type of stuff because I have zero edge on that. Zero. I don't know what I'm talking about. So I spend time looking at things. Like if somebody tells me, all right, China is way ahead of the U.S. on data centers. I'm like, well, is that true? I know people are saying that, or China is accumulating gold left and right. How can we measure that? Can I go deeper and try to find a way to calculate something that gives me some knowledge about this? I do not take anybody else's views on face value. I definitely double check a lot of work. And then you end up finding stuff, And
so let me ask you about. Can I ask you some questions about this? And
sure.
I just it's a rare opportunity. I get to talk to the person who built the thing and ask a question about it. Oh, sorry. Can you bring the chart back up?
Yeah,
it's actually about the chart.
No problem.
Okay. So right there, I get it. It's profound, right? We've got this moment where first time since 1996, the gold holdings as a percentage of foreign reserves exceeds U.S. Treasury holdings as a percent of foreign reserves. Now, how much of this is actually because so first of all, are we trying to signal that people are accumulating gold more than they're accumulating the treasuries, like the U.S. treasuries? Or are we saying that the value is just like how much of this is value versus accumulation? I guess that's my question.
Most of it is value, and we don't know the yellow line, how much is true. It could be much higher already in terms of the accumulation. What if China is really accumulating a lot more than what has been reported? I'm taking what they said as face value. So this chart's being conservative on that front. The blue line is very solid, I think, which is U.S. treasuries and owned by foreign central banks. And we know that there's a big difference here. So when you look at foreign data for holdings of treasuries, you're going to find two different things. This is another chart that you can use as well. Mm-hmm. Sovereign institutions that are private institutions have been buyers of treasuries recently. I mean, big buyers. Their chart of holdings is going like this. And central banks are not buying anymore. Like there are a few central banks that are buying. And I think it has to do with maybe a Mar-a-Lago Accord happening that we don't know yet. Like the
Got it.
UK, since February, the UK government just bought $175 billion of treasuries. This is not being reported anywhere. Like, that's a big deal. $200 billion of treasuries is a huge amount. If you look at that 7-month window over history, we haven't seen that many times in history. Spain, last month, reported their largest purchase, I think was, I don't know, 15 billion or so in history of treasuries. So there's a few central banks that are buying, and I think it's agreements with the US. We don't know what's going on. But it's curiosity, right? Like a chart like this, you just start building your curiosity. You're a curious guy. Like you start, okay, so then what is that? Then, then you're like, well, holy cow, like they just crossed now. They own more gold than treasuries. Interesting. And my question was exactly what you asked. Is this accumulation or price change? Price change is majority of it, from my understanding, but sure there's a lot of accumulation causing the price change too.
Yeah, it's fascinating. I've never been a big technical guy. I like these charts. Like this one was awesome. This one's awesome, and most of the ones you do, I really like them. I do recall a time when I went down like the sort of technical charting rabbit hole early in my investment career, we'll say, where I was like, oh, there might be a magic bullet in here, and I kind of determined that there's really not those types of magic bullets. Available all the time in that space, but they still could tell you things. But this one's pretty cool. This is like very compelling. This is something big is happening, clearly, that hasn't happened for a long time.
But I think it's also something fundamental about doing your own work that is important for investors, because there's a sentence I like to say that usually resonates a lot to what I do, which is you can borrow someone's thesis, but you can never borrow their conviction. And there's a big difference between that. So I'll explain a little bit. Like someone that hears, let's say, a commentator talking about gold, and they go ahead and use their 401k to buy some gold. They do well, and then they start doing bad, and gold prices start to decline. They have not done any homework. They just trusted somebody else's views. They borrow their thesis, not their conviction. The guy who built the thesis is looking at the situation and saying, well, this is a great opportunity. I guess I'll buy more. And the guy who doesn't have the conviction, what is he doing? I'll tell you what he's doing. He's emailing the other guy like crazy, asking, what's going on? You told me to buy. And I get that all the time. I'm like, I didn't tell anybody to buy anything.
Right.
I'm sharing my opinion. And if you want to borrow that opinion, go for it. And they have zero conviction and zero, support to acquire more of that asset, whatever that is, a company, a stock, a gold or whatever. And that's a big change on building wealth. We know that building wealth comes a lot on the accumulation when moments are difficult and taking advantage of volatility. And I think that's a big difference between smart money and dumb money in general. And I've
definitely made some dumb money mistakes along the way. I just learned from them. I've panic sold before. And so when this time around, it came around, I was like, I'm not selling. I'm not giving in. And it was like day 2, even more. I was like, I'm still not, I've been here. We've been here. I'm not doing that. And because of the conviction piece. But yeah, I guess for some people it takes a long time. And a lot of people just don't want that level of commitment to have to understand what they're investing in, which brings me back to this institutional capital point. You brought it up a couple of times. You mentioned, like, where's the institutional capital? And I guess my question for you would be, like, what institutional capital? Like, does it even exist anymore anywhere? Like, do VCs, the tech VCs that got the Bezos and whatever funds and all the sovereign wealth and pension plans threw money at them to invest in ideas. A lot of money seems to be sort of in some ways decentralized, but there's a lot more passive money management today, a lot of more passive options, ETFs, things like that. They've enabled people to take their investing into their own hands. I mean, from a fund side, you guys arguably would be institutional capital in the space, as would we, I guess, with Earth Labs, to be fair. And so, like, but there's not a whole lot going on. A lot of these big banks, a lot of these big funds have gone to passive money management. They're not really, there's not a lot of active capital anymore. Is that coming back, do you think?
Well, I think
For
there
this
is a
space?
necessity aspect that is about to hit the market. I changed it to this chart because I try to explain maybe my views on this with this chart as well. But I think before we were trying to create a compelling case for mining from a value standpoint, from an investment standpoint, and it was difficult. People were not really understanding that aspect very well. Some of them got it, but value investing is, arguably dead. I think it's coming back, but as we see volatility and other things, value investing should come back. But, over the last few years, it's been a very hard sell. But there's a necessity for mining now with all it's been happening with the AI and onshoring that we're seeing. AI to me is absolutely critical when it comes to institutional capital coming back to the space, and I think it's very different than what we saw during the internet. The internet wasn't so much our arms race; it was really kind of a great technological advancement that created a bunch of very valuable companies. AI, on the other hand, it truly creates this sort of sense of urgency to get there first from countries, from companies, and it almost creates this environment of war where governments and private institutions are willing to spend any capital that is necessary to build infrastructure to give them a chance to get there first. And when we start thinking about where is the money, like you asked, where is that money going to come from? Like what institutional capital? So I'm not calling the technology sector in general as institutional, but there's a lot of institutional capital there, that created this $27 trillion bar on the information technology sector, including Alphabet, Meta, Netflix, and Tesla. And you look at this bar, $27 trillion, and their balance sheets are clean. They have no debt. In fact, they have cash. And you think about, all right, can they leverage this balance sheet and start spending on infrastructure? Yes, absolutely. I would not doubt this at all. There's certainly a question about how would the market behave, investors behave, as they see all these companies taking on, call it 30-40% of debt on their balance sheet, and the deterioration of their health of the balance sheet. How would that behave with investors? We can argue that probably would be negative and so forth, but they are generating, like the Mag 7, even a more narrow calculation here, the Mag 7 companies are generating somewhere close to $500 billion a year in free cash flow. 90% of that capital is going back to them. They're paying on buybacks and dividends back to the shareholders. So what if they decide to spend $500 billion a year on infrastructure? Where is that money going to go to? I call the three buckets. I think there's going to be three buckets we're going to see that money go into: energy, infrastructure, and materials. You can pick your best way of exploring some of those industries and sectors, and it's going to be nat gas, solar. You can go into the coal industry as well. Infrastructure, you're going to see utilities, engineering firms. Materials, you're going to see cement firms, iron ore, obviously mining. There's so many things, and
Hard assets. Yeah,
it's going to be a lot of money, rotating into this space in a big way, in my view. And there's a lot of money that can be unlocked or created from the size of the balance sheet and the value of these technology companies today. That's the institutional capital that's probably going to come into this space by necessity, again, not because they want to be invested in mining because they think it's a great investment, but because they have to and they need to. So
yeah, it's strange because a lot of it, I agree that there's going to be this big transition, I guess, in principle, from the ideas economy to the hard asset economy. I think this is kind of saying the same sort of thing. You've got this sort of ideas market where you've got this like sort of soft world versus the hard asset sort of world. And, you know, the alphabets and the, you know, these are all ideas companies, right? And so, like, again, though, some of this money, I mean, I've been exposed to some of the underbelly of this, which is like these big VCs and stuff, and they have very strict mandates. Like, a lot of it's like ESG, and it's got to be environmental, and it's got to, you know, it's got to be all rainbows and butterflies for it, and it's got to be this, exactly that, and, you know, and then it has to be private. They only like private holdings because otherwise you get an SVB bank happening every day if it's not. So, I just, it's really weird to me. I feel like a lot of that big capital is going to be locked up somehow. How do you dissolve these things and say, you know what, actually throw that out the door. We're going mining, baby, or we're going into other things that are not what we said we were going to do. And as a fund, I mean, that's like a lot of these venture capital funds. You know, there's a huge concentration of them in Silicon Valley. Let's be frank. You know, and in Florida, I guess. But like, I don't know. It's weird to me. It's weird to see how this is going to behave the way institutional capital used to behave in the space.
I think as we invest, we got to be very aware of what the holes are in our own expertise, and there are plenty of holes on my side, but one of them is technology, and I've missed many technologies that I thought were not going to do well and did very well. Yeah. You definitely do not want to listen to me about technology, but I'm aware of it, and I listen to a lot of guys that have done very well, and I have a lot of contacts on that too. And I find it remarkable that they're starting to talk about mining, starting to talk about resources. They're starting to invest in resources. They have no idea what they're talking about. We're in the same group chat that Quentin said all these things about rare earth. It is so true. It is such I love these things when become, you know, the new thing. Lithium was a few years back, and you know, you would get from a technologist, they would talk to you, and they didn't want to talk about gold or copper or any copper. They didn't even understand the copper market.
But they're into like the scamiums and like the weirdo things that I can't, you gotta look them up on a periodic table. Like, they're into that, and you're going, okay.
It is the strangest thing, and I agree with Quentin's view, which was basically that this market is too small to chase. You know, like, why am I going to spend all this capital and effort if it's just too small? Like, let's just say it triples from here, quadruples from here. It's still too small. Like, we're talking, you know, a rare earth demand 6 billion, maybe will grow to 30 billion. That's a huge growth, and it's still not attractive. I mean, what is the market in gold? You know, copper. I don't know. That's
you produce an ounce of gold, you can sell it tomorrow. You can sell it in an hour. You know, no problem at all to anywhere you are in the world. There's somebody will buy that gold from you. With a lot of this other stuff, it's just the market share is just not big enough. Like, I remember graphene was a thing. Do you remember the graphene thing? Right? And everybody,
isn't it always a thing though?
It's like graphene. It's like you can fit all the world's total consumption of graphene in like a couple of backpacks. Like, it's like nothing at all, right? And they're, well, it's worth this much, pound. And it's like, well, let's calm down. Like, we don't have fair, but there's not a lot of graphene being done right now. So anyway, I don't know. I agree. I agree with Quentin on the rare earth thing. Or raw earth, as I like to call it now, thanks to Donald Trump and the Ukraine. He called it raw earth.
I would say that us as resource investors, we got to be aware, though. And like, one thing we learn is to be extremely open-minded to things. And one thing I'm very open-minded to it is we're going to go through a period of a construction boom, truly. That is going to be probably backed by private entities, not so much government, believe it or not. Government may push these private entities to do it, like we're seeing in some cases. And as we see that money flow into it, we're going to see construction like there's no tomorrow. Data centers, utility companies are going to be building things, revamping their technologies, and at the back end of this whole process, once we build things and we have the robots and all the things, we're going to get into a very deflationary world. And I am an inflationista for now, but I'm ready to flip as soon as I see that the building has been done and we're ready to see the fruits out of AI and all that. And I think that's going to be a very different world than we're in now.
Totally. How fast do you think it's going to happen?
Look, I that one I don't have a gun in my hand.
No, I'm not asking for like a prediction of like when, but just like how fast do you think it could unfold? Like the actual, like the rate of you know.
I think will take a while. I think will take at least, I'm going to guess a decade, if not 15, 10 years, but we can revalue this, right? 3-4 years from now, we'll look in again. I mean, where's the mining industry? Have we spent enough money for this and that? Have we seen shortage of electricity consumption and all that? Like, I think we're going to get into that too. There's going to be countries like Brazil, for instance, Argentina's in that camp as well, that have renewable energy, not because they wanted to do things for climate change, because they're, some of these countries are blessed with natural resources like rivers, that allow them to have a more stable energy source. And so Brazil right now is a great example that is producing more energy than that they actually use. It's a matter of time to see Amazon knocking on the door and saying, hey, I need energy. Can I build something over there? And so we're going to see a lot of integration with countries that are in those situations. And
I'll actually make a wacko prediction too on that, because I think that energy costs are going to go so high, right? Because the demands are there and they're only getting higher. But I think energy costs are going to go so high that things as like kind of these Looney Tunes ideas like solar, like everybody, I get the subsidies, I get solar, trust me, I get it. But if you triple or quadruple that energy price, right, and you live in a sunny place like Spain, like Arizona, whatever, like the yield on these panels is so insane, the payback cycle, the way that it could be widespread to retail on residential housing and everybody could have it and adopt it, and so to your point, places blessed with water and rivers. Well, there's places blessed with sunshine. And I think that it would not be beyond me to see a big disparity in the quality of life and living standards in regions just based on how much sunshine they have, or if they've got like nuclear or something, like, the small modular nuclear everywhere. I don't know, but the whole energy thing to me is super fascinating. And if you believe in like the robotics and that whole AI revolution and, assembly lines of robots, building assembly lines of robots and how fast that can all unfold, I don't know. I mean, we could be living in a totally different world in 10 years.
Well, think about this too. Sorry, we're probably going long here, Brett.
It's okay.
I was speaking with a guy, fascinating guy. If you haven't talked to him, maybe you should talk to him as well. Not that I don't like his talking about like vision from a macro standpoint. Didn't know he had put so much thought into this. The guy from CEO of Metalla, Brett Heat, you probably know him.
Oh yeah, Brett's really smart. Yeah.
We had a lunch one day, and we went on a crazy conversation of macro, and it was fascinating. He said something I completely agree. I'm giving credit to him because he deserves it. What if, after that world that we build things, or in the middle of it, as we build things and we start seeing robots, we start seeing mines that now are operated by 300 people or operated by 13 people.
And robots.
24/7, no politics. Think about that. Like what's going to be your, like we talk about how companies lack on, are almost, missing on their production guidance and all these, and instead we just see a steady, really strong, solid productions profile for all these mining companies, and their margins are stellar now. And us as investors, we got to think about this. We got to think about, all right, if that's the world we're probably going to be in, call it 10 years from now, maybe more, maybe less, we want to be taking operational risk, if it makes sense, all day, right? We want to own high quality assets that can be operated by those things in the future, and take the fruits out of that whole thing. I mean, that would be an insane world once we get there. So
yeah, absolutely. And I think, just to double down on that, I think one of the big drivers for me, because this has been an idea that I've played with forever, literally, because when we started with Gold Spot, right, with AI for mineral exploration, you don't start one of those things and work in that without every night dreaming about where AI is going to take the industry, right? So like you're like thinking about robots and self-operating mines and like blah, blah, blah. And you start getting crazy with it. But at the end of the day, one of the things that I realized real quick with that was that, like, yeah, on the discovery side though, like that's why real estate packages matter. I always like big real estate packages, and I like that discovery side of the business, because on the operating side, if your edge is that you're a great operator, but all of a sudden robots come in and automation comes in, and it's just like everybody's a great operator, so what, right? But if you have the land with the deposits on, or that gold belt, that greenstone belt, or whatever it is, right, where it's a good hunting ground, and we played with all the data sets, we played with all the toys, all the tech. There's no silver bullet. There's nothing that gives you that precision of like, there's the deposit and there's another one and there's zero risks now, we can just drill them. That doesn't exist. You can refine the process, you can improve the odds, but we don't have anywhere close to enough data collected around the world of various types to be able to have that type of precision right now. So it doesn't really matter where that tech goes. It's not going to, like, there's going to be a period where operating will be easy and discoveries and those who have the claims will matter, will be the most valuable, I think.
So let me ask you a dumb question from my side. Are you done with your thoughts? Sorry, I didn't mean to cut you off.
No, I'm done. Yeah, totally. That was my piece.
Do you think we're going to get in a world where we're not going to be drilling anymore? We just know what's in the ground?
No.
You don't think so?
No. The only way to do that, no, there's no way. Not with any of the technology we have today. I mean, I can't say there's no way. Anything, I guess, is possible. Like if some physicist invents some new fucking gadget that maybe does a thing that, with some sort of properties or whatever. I don't know. I guess anything is possible. But with what we can see today, and even what we can see in the R&D pipeline of what's on the horizon, there's nothing like that. There's nothing that would be able to inventory a deposit. Now, it depends what we're talking about, right? Like if you're talking about like potash, yeah, maybe, or if you're talking about, like, even look at like oil with seismic, how effective seismic is with oil, right? It's very good. Seismic in the mining world, I mean, it can tease out some features, but nothing, we don't have anything right now that gives us enough. First of all, sort of the only true 3D geophysical property that we can collect is seismic data. People talk about 3D IP and 3D EM and all these sorts of things. That's all bullshit too. It's all wizardry. They're pseudo 3D products. They're not really 3D products. Seismic is really 3D, and it's the only thing that's like that. And by the way, for like Newfound Gold, we spent like $12 million doing the claims with seismic on the north side. Like, it's not cheap. It's not even remotely close to a toy that anyone can afford to play with. And if it was a rock solid, silver bullet where you absolutely can't miss, then we would have absolutely not missed. Does it help? Of course it helps. Does it reduce the risk, improve the odds? For sure. But the big thing with AI and this sort of stuff is it's like garbage in, garbage out, right? And it's being able to collect like the granularity of the data that you're ingesting and collecting determines the granularity of the product that you're spitting out. So you could have really cool satellites that take like countrywide, data sets or big airborne surveys that do things at like very coarse spacing. Well, you're going to have like a coarse output too. Right, because you have coarse data to work with. It's the same as this. Like I can't give you like monthly market data for the last 100 years and ask me to predict, what's going to happen on an hourly with hourly precision, right? Like it's just impossible. So yeah, I don't know. I mean, look, it's kind of like the question of like, will science ever cure cancer or vaccines or whatever? And it's maybe.
That's a good answer. Let me, I just speak with a lot of geologists and I ask those questions as well, and yours is fairly consistent to some of the smartest guys I talk to as well, including Quentin. But, we have geophysics really, I would say, arguably it really changed the industry for a bit. And I think unleashed some discoveries and so forth. What do you think is the next technology that could cause that fundamental change in this exploration realm of the industry? I mean, I can maybe say something about on the producing side. I think if somebody ever figures out treating refractory ore very economically, it's going to be a big change in supply of metals, and it's going to change the value of a lot of projects out there that are currently being discounted for those reasons. Don't know exactly the complexity of how to fix that issue, but what do you think is that in the exploration realm?
Well, a few points. One, it depends what we're exploring for. So like for instance, like the geophysics argument. So like imagine our exploration target was iron ore, right? Well, like the magnetic airborne surveys, which was like sort of the most rudimentary version of like airborne geophysics, is like unbelievably accurate and unbelievably valuable, right? Like it basically is 1-to-1 with discovery when it comes to these things. Like if you validate it in a couple of times and okay, now you can use that and you pretty much roughly know what you've got. So anything I'm going to say has sort of like these little caveats, right? But for let's say, what do I think is going to be the biggest, most disruptive thing? Well, I still think it's going to be AI, and the reason I say that is because, and when I say AI, what I mean is data science and machine learning. And the reason is because I still think that we do a far better job collecting data than interpreting data. So when we can be 100% efficient with at least interpreting all the data we collected, we're like a really shitty CIA where we have agents all over the world collecting information and building up information and archives. And there's literally archives of data all over the place. And we have like a couple of analysts in Langley that are combing through it one at a time, and they're just human beings. That's kind of like the data collection versus interpretation disparity in the industry. So I think that's probably the number one. Number two, in terms of like innovative technologies and what's coming down the pipe, I think passive seismic to me is very promising. So the way this works is like you set up these array of geophones. They're like these seismic, like traditionally with a seismic survey, you would set up these geophones, right? And then you'd have a source like an explosion or, a thumper truck or something, and it would create a shock wave. And it works like kind of like an ultrasound, right? So the shock wave bounces off things and then the geophones pick it up and record it. And with passive, what it does is you can like put all these geophones, just a random, like a big array of them everywhere, and they just read continuously. So they'll read like for 2 months straight, let's say, because there's a battery in each geophone, and it'll relay the information, send its information back. And so, but you don't actually have an active source. So you get a fuzzier image, right, of what's going on, But the only reason that's possible is thanks to cloud computing and thanks to being able to handle terabytes and terabytes and terabytes of data. Before you had to, there was limits on what could be processed. So I think like passive seismic's very promising because again, it is 3-dimensional. And I think there could be big improvements there. And with improved, like even today, a passive seismic system, there's a few groups in the world that are doing it. And we actually looked at buying one of them to offer this service as well with Goldspot once upon a time. And what we were going to do is, offer this service, but you still have to kind of downsample the data before you process it because it's still too big to process efficiently. And so again, that's like a computing hurdle, which I don't think is a big deal. I think that's look at like crypto and what's going on with NVIDIA and all this kind of stuff, like these new chips and stuff. Like they're able to do some crazy shit. So I think passive seismic is really interesting. Another feature that would be really cool if they could figure it out would be drilling. Like how do you disrupt that game? Like drilling in. And like there was one guy from California, private company. I was introduced by somebody else to this guy, and he was basically having like a crewless drill, but he had figured out how to kind of automatically have a drill and extract core, I guess. But he still hadn't figured out how to get the core out of the tube and into a box and then back down again. And I was kind of like, buddy, that's you don't really have much of an innovative tech until you can crack that enigma. Yeah. So you're still at phase 1, I think. But nonetheless, some guys in Silicon Valley were throwing money at him. Like I think the Jeff Bezos fund hit him over the head with a few $1 million at a stupid valuation. But I'm supportive of all these people. I think like at the end of the day, hopefully like go solve a problem for us, man. But it's not looking promising right now. But that could change really quickly with some money. So, but yeah, I think drilling's interesting. Drilling tech. That if you could figure out a way to stick more holes in the ground, I think that would go a long way, because you're always going to have this problem where if you have a technology, you're no matter what, you're always going to have to validate. You're going to have to validate what you think is there. Yeah. Right. And that's the real cost. Yeah. It's like, to prove out a few million ounces of gold, if let's say it's an orogenic system, it could cost you $150 million. If you're going to prove out, a couple million ounces of gold in a porphyry system, or like a Nevada thing, it could cost you 30 or 50, right, in drilling. Yeah. So that's again still the de-risking these things. That's probably the tech to watch, I think. But yeah, I don't know. Like. I don't know. I hope somebody proves me wrong. Hopefully there's something that comes out and gets invented.
I think these questions, arise all the time, for me at least, because I think of the risk of at least the thesis that we have, you have as well, of metals and mining doing very well for the next, decade or so. And a lot of that view is predicated on a lot of the imbalances macro-wise, but we also need to understand you can make that same point on hard assets overall. And so why mining, right? Like why not? There's so many hard assets. Why did you pick mining? I picked mining when I saw the trend of, okay, we should probably be investing in hard assets. It was around 2019 or so. And the reason for it was because, if you just do an analysis of duration of the industry to go from acquiring a property to getting into production, it's the longest of them all. And so the cycles tend to be inherently long as well. But these technology changes can certainly disrupt that time. And if that ever happens, it could change the length of the cycle. Indeed, I don't think it would change the views in 3 to 5 years, but 7 to 10, yeah, it could change. And so I pay attention to those questions a lot. I think that's an important exercise that we should all do.
Well, the other thing is, like we saw in tech, when you have more money flood in, like when the thing is more precious and it's more worth it, then you have smarter people trying to solve the problem, deeper pockets trying to solve the problems, everybody trying to game it. Yeah. And then you're going to have this sort of asymmetrical acceleration of like innovation and change, right? So the change would never be sort of a linear thing. It'll be some sort of like a hockey stick type of thing. But that comes with, the things becoming, what do they say? The cure for higher prices or high prices is higher prices. So it's sort of like in response to that, I think, like, yeah, you're going to get a lot more. I mean, sort of, you could argue the same too. Like when times are bad, people are trying to innovate to make it better. But I think when times are good, people are trying to game it. And that's when you're going to see, accelerant getting thrown into the mix. So I don't know. Yeah, I think there's certainly a lot of great leads on that front. And it is possible that in the next 3 to 5 years that you see some major technological disruptions to mining that definitely throw askew a lot of what's going on.
And that's the other thing that is not priced into looking at these mining projects when you go acquire them, especially producing mines. The cost structure, because of the history of costs always going higher, right? I mean, what if we get in the world where you can actually reduce costs substantially? And, man, that could change the NPV of so many things. I mean, it could be a crazy world if we get into that. So,
well, right now you have a lot of traditional mining money that has a myopic view, or at least a limited view that's based on history, determining what value is and what the pricing is and what's appropriate market cap and what's an appropriate amount of exploration budget and so on and so forth. That's totally changed. Drilling 10,000 meters today is remarkably more expensive than drilling 10,000 meters in 2005 or 2010. It's totally different. And so, that I haven't seen that priced into things at all. So as much as innovation and efficiencies can be gained, I think we also have to come to Jesus and say, okay, listen, the world is a more expensive place. The salaries you have to pay people, the consumables, all these sorts of things, everything's gone up. So we're not going to be able to get as far with as little dollars as we did back then, So some of the philosophies of even like ounce counts and like how big how big of a deposit matters. Like that's.
Do you agree with the refractory comment I made at all? Not that it's necessarily my view, but that if we learn how to economically treat those things in scale, it would change the industry in a big way.
Yeah, totally. But one of the interesting things there is that like you had so one of the big innovation techs that existed on the refractory front for POX plants and all this kind of stuff is this whole bioleaching thing. Have you heard of this? So these are little bugs that eat these, nasty sulfides. So the sulfides are like, enclosing. For the listener, Tavi probably already knows this, but for the benefit of the listener, when you have basically like poicolytic gold, you'll have like gold, for instance, that's locked up in arsenopyrite, let's say. And so you'll have a sulfide mineral like fool's gold, and inside of it you have little things of gold. And the only way to get to that gold is to crush this up to shit. But it doesn't matter how much you crush it, you still can't quite get all the gold separated. It doesn't just separate out. It's not on the outside of the, So what they have to do is they got to cook it. And they got to get rid of, so they have these things called autoclaves, right? Where it's like pressure oxidization, and they basically POX plants, and they get rid of it. So then basically in the 1980s, I think it was the 1980s where the tech was invented, is they figured out some sort of, or 90s maybe, and they figured out some sort of little bugs, like little bacteria that will eat this stuff, and they won't eat the gold, but they'll eat the nasty. And this worked pretty well. Now, the interesting thing is there was like one company that had the patent on that. And so the cost of doing it was like basically on par with the cost of putting in a POX plant, because you had this company that had this patent for like 30 or whatever, 35 years or whatever the patent length is, and whatever. And basically what happened a couple years ago is that came off patent. So now you can life brand, here in Canada, or I'm not sure, in the United States, do you guys have life brand? It's like the generic branding of like medications. You can do this now with, you don't have to buy the Advil anymore. You can get the, the discounted, brand. And so now this methodology and the sauce to do this is now off, is sort of like anybody can do it now. And so it's interesting that after a couple years of it being off patent, we still haven't seen this massive like rollout of adaptation. But in the cases where it has been used, it does show to be really effective and really good. So I'm really curious to watch that on the pressure oxidization front, on the refractory side. That's a really cool tech solution that we have today. And the reason it wasn't being used was because of this whole patent thing.
Yeah, that can change the game. There's a lot of deposits out there underdeveloped due to that, and I think it would change supply curve a lot. I don't know if immediately, but it could change in 7 years. It could change it drastically. So it's something to be aware of.
I'm sure they could build a POX plant today, Tavi, that's pretty damn efficient and pretty damn clean. Like,
yeah,
it's probably not. It's probably like, I mean, there's a cost for everything, right? If gold goes to $5,000, $6,000, trust me, and there'll be 1 gram refractory as shit deposits getting
100%. Yeah. As long as the cost doesn't go higher either.
Yeah.
Which it's gonna catch up too. I mean, at some point we're gonna see that probably going up, unless we see the things we're talking about here. But that's a possibility too.
For sure.
But
so where can our viewers watch you? You've got Tavi Costa on X. Is that the easiest place to follow your work?
Yeah, you can follow my work there, or LinkedIn as well. You can just type my name, or it's the same thing that posts in both places. Or our website, Crescat.net, is where we publish longer letters about our views and what we do as well. So those are the areas you can find something about me if you're really bored.
And is Crescat always taking in new money? So if some of our listeners, they love Tavi, they love Quentin, and this whole world, and they want to invest with you guys, is that always an open door with you guys?
The fund is closed. No, I'm joking. It's open. I love when people say that their fund is closed. Yeah. It sounds so cool. No, mine is always open.
Yeah, ours is closed. Ours is closed.
So maybe I'll get to a level where I can just say it's closed, but not yet. So
very cool. Awesome. Well, thank you so much, Tavi. It's been great. We should do this again, catch up. Thanks for breaking the ice with me on the first podcast in months. So,
Terry, I didn't know that. All right.
Yeah, it's been a while. Like I hung up the skates for a bit there, but this was a great one to come back with. So thank you for that.
Well, thanks for having me. I really appreciate that, and congrats on everything you built as well. And
thank you.
Looking
Likewise.
Forward to doing more of this.
Yeah, man. Take care. Cheers.
Take care.